let's jump right into a massive tax trap that catches so many practitioners off guard. We all operate under the assumption that property transfers in a divorce are tax-free. But, as we're about to see, when one spouse is a non-resident alien, that assumption isn't just wrong, it can be a multi-million-dollar mistake. Okay, so let's start with the basics. The principle that every single domestic relations attorney has etched into their brain is Internal Revenue Code Section 1041. It's simple, right? It says when property moves between spouses during a divorce, it's a non-recognition event. No gain, no loss. For tax purposes, it's like it never even happened. But what's fascinating is how one seemingly small fact can just detonate that entire rule. And that fact is the tax residency of the spouse who's receiving the assets. This is the tripwire. The second the recipient is a non-resident alien, or an NRA, as you'll often hear, that protective shield from Section 1041 can just evaporate. So to really get our heads around this, here's how we're going to break it down. We'll start by busting that tax-free divorce myth. Then we'll look at the specific code section, 1041D, that acts like a kill switch. We'll cover the nasty consequences, gains, losses, and withholding. Then we'll pivot to the gift tax mismatch. And finally, we'll build a toolkit for navigating this whole minefield. All right, let's get right into the code. The entire problem we're talking about comes from this one little subsection that acts like an override, completely turning off the tax protection we all take for granted. So here's the rule we all know and love, Section 1041, subsection A. It's crystal clear. No gain or loss shall be recognized. This whole thing came about to overrule a Supreme Court case, United States versus Davis, that used to make these transfers taxable. Congress basically said, no, that's a bad idea, and gave us this blanket rule of non-recognition. But then there's this, Section 1041, subsection D. It's one sentence, but it's got the power of a wrecking ball. It says that the general rule in subsection A shall not apply if the spouse getting the property is a non-resident alien. The logic behind this is pretty straightforward. The government doesn't want appreciated assets moving tax-free to someone outside the U.S. tax system, where that gain might never get taxed. And this is absolutely crucial to understand. The rule is completely one-sided. It only bites when the recipient is the non-resident alien. So if a U.S. spouse sends an asset to an NRA spouse, boom, it's a taxable event for the U.S. transferor. But if the NRA spouse sends property to the U.S. spouse, Section 1041A is still in effect. The IRS is perfectly fine with that, because the asset is coming into the U.S. tax net. So now let's unpack what this really means for the U.S. spouse who's making that transfer. It's not just one problem, it's a triple threat. You've got 3 different, very painful financial consequences hitting all at once. First, you have to recognize the gain. With Section 1041A out of the picture, the transfer is now treated as if you sold the property for its fair market value. So the U.S. spouse has to calculate the capital gain and write a check to the IRS right away. We call this a dry tax event, and it is just brutal. You're paying real tax on a sale where you received 0 cash. Second, and this is the real kicker, while your gains are taxed, your losses are often disallowed. If you transfer an asset that's gone down in value while you're still legally married, Section 267 kicks in. It says you can't deduct losses on sales between related persons, and, yep, a spouse counts. It's a classic heads the IRS wins, tails you lose situation. And third, this whole thing triggers some really complicated withholding rules. The IRS isn't going to wait around to get paid. They make the people involved in the transaction collect the tax for them. This means the U.S. spouse, or sometimes a buyer, is effectively deputized as an IRS collection agent, and if you fail to do it, you can be held personally liable for the tax. And here's where it gets really severe. Look at the Foreign Investment in Real Property Tax Act, or FIRPTA. Under Section 1445, if you transfer U.S. real estate, you could be looking at a mandatory 15% withholding. And listen to this, it's 15% of the gross fair market value, not 15% of the gain. That is a massive, massive number. For other kinds of U.S. source income, things like pre-2019 alimony or investment income, the default withholding rate under Section 1441 is even higher. We're talking a flat 30%. Now, you might be able to get that rate reduced by a tax treaty, but that's only if you have all your ducks in a row with the right paperwork, like a Form W-8BEN. Okay, so just when you think you've wrapped your head around the income tax rules, we have to pivot to the gift tax world. And guess what? It runs on a completely different set of rules. This creates a whole new trap where you can fix the income tax problem only to fall right into a gift tax one. So here it is, the core mismatch. For income tax, that Section 1041D problem is all about the spouse's residency status. But for gift tax, the magic word is citizenship. This means your client's spouse could be a resident alien for income tax, avoiding that whole gain recognition issue. But because they aren't a citizen, a totally different set of gift tax problems can pop up. So, specifically, Section 2523I says, you lose the unlimited marital deduction for any gift to a spouse who is not a U.S. citizen. You know how citizen spouses can give each other billions of dollars with no gift tax? Well, if the person receiving the gift isn't a citizen, even if they have a green card and are a permanent resident, that unlimited deduction is just gone. Now, the code does throw you a small bone. There's a much larger inflation-adjusted annual exclusion for gifts to a non-citizen spouse. For 2025, we're talking about $190,000, which sounds like a lot, but it is a far cry from unlimited. And in a high net worth divorce, you can burn through that in a heartbeat. So here's your escape hatch. The key to planning is using the safe harbor in Section 2516. This is your get out of jail free card. It says that if a transfer is made because of a written agreement and the divorce happens within a 3-year window, from 1 year before the agreement to 2 years after, it's treated as being for full consideration. And that means, poof, it's not a gift and the gift tax problem goes away. Okay. Wow, that was a lot of bad news. We've talked about the deemed sale trap, the loss disallowance trap, the withholding trap, and the gift tax trap. So now, let's talk about solutions. Let's build the strategic toolkit you absolutely need to guide a client through this. Step 1 is always diagnosis. You have to figure out the spouse's tax residency under Section 7701B. And let me be clear, this has nothing to do with their immigration status. A person is a tax resident if they have a green card or if they meet the substantial presence test. And even then, there are elections and treaty rules that can flip the result. You have to get this right first. Everything else depends on it.
Okay, so based on that diagnosis, here's your 5-step game plan. First, see if the NRA spouse can elect to be treated as a resident. That can solve the whole income tax problem right there. Second, time your transfers carefully. If you have assets with losses, wait until after the divorce is final. That breaks the related person rule and lets you take the deduction. Third, be smart about which assets you transfer. Cash is king. Or transfer assets with very little appreciation. Fourth, protect your client with a contract. Write a tax gross-up clause into the settlement so they get reimbursed for any tax hit. And fifth, watch that calendar like a hawk. Make sure you hit those Section 2516 deadlines to avoid any gift tax surprises.
So, to wrap it all up, let's bring it back to the main point. The tax-free transfer under Section 1041, that's a privilege of the domestic U.S. tax system. It is not some universal right. And if you apply those domestic assumptions to a case with an international element, you are setting your client up for a disaster. And that leaves us with the one question, the single most important question you have to ask at the very beginning of any divorce that might have an international connection. Is the other spouse a non-resident alien for U.S. tax purposes? Before you even start talking about who gets what, you need the answer to that question. In the end, it all comes back to the words in the code. That one little sentence in Section 1041D is what creates this entire, incredibly complex and painful situation. Understanding exactly what it means and how it interacts with everything else isn't just good advice, it's the fundamental duty you owe your client when they're navigating an international divorce.